Urgent waking up to find $500 million locked tight by the government. Recently, the Enforcement Directorate attached 505 crore rupees in overseas bank accounts linked to the real money gaming platform Winzo. But investigators say that headline figure is just the visible tip of a much larger 3,500 crore rupee allegation. This action creates a window into the mechanics of India's digital economy, a sector where massive numbers and rapid expansion often move faster than oversight. The Winzo case matters because it moves the story beyond simple corporate growth. It forces a sharper look at whether a platform's success is built on a sustainable product or on regulatory gray zones and hidden mechanics. India's multi-billion-dollar consumer internet sector thrives on a simple promise: whatever you want, right now. It is a frictionless economy built entirely around instant gratification. These apps are meticulously engineered to compress the time between you having an impulse and spending your money. The interface removes every possible barrier to that transaction. Global investors pour massive capital into this space for exactly that reason. They know that capturing a user in a fast, repetitive loop of unthinking consumption guarantees highly measurable revenue. But when an entire industry optimizes for pure velocity and habit formation, the boundary gets blurry. The design choices that drive legitimate repeat engagement are the exact same tools that can be used for behavioral control. The Enforcement Directorate alleges users were frequently matched against bots and AI-driven profiles, not real humans. In the backend, the system used designations like persona and PPP to disguise simulated players, ensuring the human user never knew they were playing the house. While the games were allegedly set up to drain deposits, the platform placed severe restrictions on withdrawals, making it incredibly difficult for users to pull out any remaining cash. By combining bots with a system that prevents capital from leaving, the platform created a closed loop where user losses converted directly into corporate commissions. That extraction adds up quickly. Beyond the initial frozen assets, investigators suspect the total proceeds of crime exceed 3,522 crore rupees over just a few years. The mechanism to handle this capital was complex. The allegations suggest user losses were systematically converted into internal commissions, carefully untangling the funds from the gameplay itself. From there, investigators say the sanitized funds flowed outward, leaving India entirely and pooling into opaque corporate structures in jurisdictions like the US and Singapore. Moving thousands of crores through international corporate architecture requires deliberate planning. The system functioned exactly as it was designed to. This pressure to scale quickly isn't unique to gaming. You see it in the quick commerce sector, which shares the same hypergrowth DNA but uses a completely different financial engine. While the gaming allegations involve extracting user cash, quick commerce survives on the opposite, burning investor cash. The industry spends roughly 5,000 crore rupees per quarter to maintain the appearance that ultra-fast delivery is a cheap, sustainable utility. Behind the scenes, executives fiercely debate these burn rates in public, fighting to convince anxious investors that their specific cash drain is disciplined and strategic. Whether a company is allegedly matching users against bots or burning billions to subsidize groceries, the end result is the same: a high-velocity growth story masking fragile or non-existent profitability. Eventually, the private venture capital money runs out. That's when these fragile, cash-burning structures open their doors to the public markets. An IPO gives early backers and founders an exit ramp, allowing them to cash out by selling shares of these unstable models to everyday buyers. This chart shows how easily retail investors get drawn in. The bright line of app installs and user growth points straight up, completely hiding the deep red plunge of unsustainable cash burn and operational rot right beneath it. If a company relies on regulatory loopholes or aggressive behavioral design to survive, going public doesn't fix the business. It transfers the financial hazard from private billionaires directly to your retirement account. When an app's true mechanics are buried in algorithms and offshore accounts, you have to look past the valuation. The most important question you can ask is never how fast a company is growing, but how honestly it's operating.